Let's go ahead and talk about the installment and cost recovery methods. The installment and cost recovery methods are used when collectability of revenues is highly uncertain. They both cause us to defer recognition of the profit on the sale until the cash is received. And again, the idea is if the collectability is highly uncertain or highly unpredictable, we want to go ahead and defer or put off recognizing the profit until we actually have the cash in our hands. The installment method is widely used in tax accounting, so this does have some genuine applications beyond the very narrow financial accounting aspects. And the two methods, the installment method and the cost recovery methods, they differ in the rate at which we recognize the profit on the sale. Under the installment method, we recognize the profit in proportion to the cash received. If we collect 20% of the sales price in a given year, we recognize 20% of the profit in that given year. Under the cost recovery method, we don't recognize any profit at all until we recover or collect all of the cost of goods sold. After that, every dollar we collect is viewed as profit. So for example, if we have a product costing $80 that we sell for $100, the first $80 we collect, we view that as getting our money back, recovering our costs. Once we recover our costs, any additional money collected beyond that is viewed as profit. So for the first $80 collected, we wouldn't recognize any profit. For every dollar after that, every dollar collected, we'd recognize $1 of profit. Let's go ahead and do a quick, easy example. Let's assume that in 2001 we sell a product for $100, which cost us $80, and we're going to defer recognition of the $20 profit until we collect the cash. And we're going to collect that $100, $50 in 2002, $40 in 2003, and $10 in 2004. First, let's do our year-end closing entry. Now, normally, we take our revenues and expenses and close them to income summary, and they go to the income statement and thence to retained earnings. Instead of doing that, we're going to close sales and cost of goods sold to a deferred gross profit account. So that $20 gross profit is going to go to the balance sheet rather than to the income statement. Now let's do the installment method first. Again, in this case, we're going to recognize gross profit in proportion to the cash received. One way of doing this is to think of our gross profit rate. Our gross profit divided by the selling price, in this case $20 gross profit over $100 selling price, or 20%. So one way to interpret that is to say that of every dollar of sales revenue, 80 cents or 80% is cost, the other 20 cents or 20% is gross profit. That means that if we collect $1 of the sales price, we'll recognize 20 cents of gross profit. If we collect $5, we'll recognize $5 times 20% or $1 of profit, and so on. So in 2002 we collect our $50, and we collect that like we would collect any other receivable, a debit to cash and a credit to accounts receivable. Now again, our gross profit rate is 20%, so for every dollar we collected, we're going to recognize 20 cents of deferred gross profit. So $50 times 20% is $10, so we're going to recognize $10 of deferred gross profit and put that on the income statement as gross profit on sales. Again, if you wanted to do this based on proportions, we collected half of the $100 selling price this year, and so we're recognizing half of the $20 gross profit this year. It's much more common, though, to think of this in terms of a gross profit rate times the amount collected. Now let's go ahead and envision two T accounts, one for the receivable and one for the deferred profit. These accounts are sort of tied together. If the receivable goes down by $1, the deferred gross profit goes down by 20 cents. So here are our two T accounts. We have our initial balance where the deferred gross profit is $20, the receivable is $100, so the deferred gross profit is 20% of the receivable. Every time the receivable changes, the deferred gross profit changes by 20% of that amount. So in 2003 we collect another $40, and again we collect that like any other receivable, a debit to cash, a credit to accounts receivable. And again we say we collected $40 in cash. Of that $40, 20% or $8 represents the gross profit. And finally in 2004 we do the same thing with our last $10. We collect $10 and recognize $2 of gross profit. Now, what happens when we have bad debts? Again, the whole point of the installment method, or the cost recovery method for financial accounting purposes, is the questionable collectability of our receivables. If a receivable is written off, we have to reduce the receivable, obviously. We take the receivable off the books. But again, the receivable and the deferred gross profit accounts are tied together. If the receivable goes down for whatever reason, the deferred gross profit has to go down as well. So let's go ahead and assume that the customer in the previous example defaults after the first year. Again, they paid us $50 the first year, they still owe us $50. That means there's still a balance of $10 in the deferred gross profit account. We're going to go ahead and charge this customer off, which means we have to eliminate the account receivable, and we also need to eliminate the remaining deferred gross profit. If nothing else happens, if we don't collect any sort of, or repossess any sort of merchandise, basically we're going to record that $40 as a bad debt expense or loss on installment receivables or something to that effect. So the $40, the accounts receivable minus deferred gross profit, is often referred to as the net investment in receivables. Now in some cases, we may repossess some asset of value. In that case, the asset is going to be recorded on our books at its fair value, and every dollar of value that we recover by repossession reduces our bad debt expense, or reduces our loss by $1. So in this case, instead of losing $40 as bad debt expense, we'll lose a little bit less. Let's go ahead and assume the same example as before, but now let's assume that we repossess goods worth $30. Again, the non-negotiable part is that the account receivable and the deferred gross profit have to come off the balance sheet. The account receivable has no value any longer, so it has to go, and the deferred gross profit has to go along with it. We go ahead and record that inventory at $30, its fair market value, and so in this case we only lost $10. We had a $40 net receivable, or net investment in receivable, and we received $30 worth of stuff for it, so we only lost $10. Where this gets a little iffy is if we recover goods worth more than $40, more than our investment in net receivable. If we recover goods worth $45, should we show a gain on repossession? So again, let's go ahead and assume we recover goods worth $45. Again, the receivable and the deferred gross profit have to come off the balance sheet. We record the used inventory at its fair value of $45, and now we're going to have a gain on repossession. Now this is, this is okay as far as the textbook is concerned, this is okay as far as the FASB is concerned, but this does rub some people the wrong way. Basically, the idea that we can profit by having a customer not pay us raises some questions. Perhaps the most significant objection to this is the valuation of $45 for the used inventory may be entirely subjective. Again, the whole point of historical cost and so on is that it is objective and verifiable. Once we start using biased or potentially biased subjective assessments of what that inventory is worth, we get into the possibility of earnings manipulation and things like that. Next, let's go ahead and look at the cost recovery method. And again, under the cost recovery method, we're not going to recognize any profit at all until we get back our $80 investment in the inventory. So in this example we've been using, our cost was $80. That means that the first $80 we collect we view as recovering our costs. Once we get past that point, the remaining $20 we view as collecting our profit. So in the first year, 2002, when we collect that $50, we haven't yet recovered our costs. Again, our cost, their cost of goods sold was $80. We've only collected $50, so we still haven't recovered our costs, so we're not going to recognize any profit. In 2003, we collect another $40. So now, our total collections are $90, which means we've recovered our $80 cost, plus we've collected $10 of that profit. Finally, in 2004, we collect the last $10. We recovered all of our costs last year, which means that now we're simply collecting the profit